different theories of consumption. And what is that makes you consume more or less from an economy? In that perspective, we looked at the main components of GDP, and we talked about consumption being the most important aspect of GDP. We also went deeper into savings aspect, whereby we looked at the relationship between savings and income. When you have more income, do you save more or do you save less? And later on, we looked at investment. A nation that wants to grow, a nation that wants to develop, in terms of economic growth and such, do we invest more or do we invest less? Having looked at that class, today we look at a different topic and a new topic called money and banking. And just to introduce the aspect of money and banking, is it possible for a country to develop, to go on, when it has just one aspect? For example, issues to do with money without banking. Or they must go hand in hand. That is why in our analysis and in our lesson, we are going to combine the two aspects, come up with an analysis why these two different variables, that is money and banking, go hand in hand. And that is why we say money is any object or record that is generally accepted as payment for goods and services and repayments of debts in a given socio-economic context or country. Whereby you want to go and purchase something, you want to go and do something in the economy, you want to go to a shop, then you want to exchange that valuable commodity you want, you must use money. That is why we say on another aspect that money is a legal tender. Money was needed to overcome the shortcomings and frustrations of the barter trade system. Initially or technically, we didn't have money coming on board. We had what we call barter trade. But barter trade led or else had major shortcomings that were different aspects. For example, lack of double coincidence of wants. You want somebody who has a cow and you want to have beans. Is it possible to get somebody who can exchange this for what you want? So getting what you want from the market was always a very difficult moment. Indivisibility problem. Maybe you are still going to the market and you want to exchange the cow that you have with maybe some beans or something of that sort. Is it possible to get half a cow, quarter a cow, or something of that sort? That is the indivisibility problem that we are talking about. The challenge of dealing with perishable goods, some commodities, the vegetables, the things to do with the maybe fruits and such, they cannot be stored for a very long time. And you're talking about the archaic regimes whereby even maintaining or else having different storage perspectives was a major problem. Was it possible to have a way of dealing with perishable goods? We also have a lack of common measure of value. If in 19th century you went to a person and wanted to maybe know the value of a cow, what was going to be the measure of that value or as measure of that commodity? It became a problem. And this is whereby we pose a challenge for you students when you are listening to this, that on your own you need to discuss the historical development of money and how these translated to even the banking sector and such. We got deeply into money, and the first thing we want to look at is the functions of money. What is that role? Why do we have money in the economy? One of the most important aspects of money is that it is a medium of exchange. It facilitates the exchange of goods and services in the economy. You want to move from here to another place, you want to go and buy a commodity. How do you do that? The only way you can do that is using money, whereby we are talking about it being a medium of exchange. The second function of money is that it is a store of value. How is it a store of value? The use of money makes it possible to separate the act of sale from the act of purchase. Sometimes, money is the most convenient way of keeping any form of property which is surplus to immediate use. You have something extra that you want to keep for future. You store it in terms of money. Thus, in particular, money is a store of value which all assets, properties can be converted. This is putting value to whatever commodity you have at such. It is also a standard of deferred payment. Sometimes you go to the shop, you want to purchase something, you don't have enough money. How do you go about that? You use money to make sure that you pay something that you may be engaged and you didn't pay in cash. Many transactions involve future payments, e.g. hire purchase, mortgages, long-term construction works, and bank credit facilities. How do you effectively carry out a credit transaction? It is only through money. It is also a unit of account, whereby money is a means by which the prices of goods and services are quoted and accounts kept. This is why sometimes, or as most of the time, even when you are quantifying everything, you quantify in terms of money. For example, you can hear somebody telling you to do something for him, and he asks you or she asks you, how much are you going to pay me? That is why we are saying it is also a unit of account. For money to be a legal tender, and for the previous or as the functions that we have mentioned to be effective, there must be the universally accepted characteristics of money. Why is it acceptable to all of us? Characteristic number one is it must be acceptable. It must be generally accepted as having value in exchange. That is why when you go to a shop with 1,000 Kenyan shillings notes, there is no excuse. When you give that amount of money, you will get value for that transaction. Portability. It must also be easily portable from one place to another and easy to carry. Sometimes when I'm even in this class, I may be having thousands and thousands in my pockets. But at the end of the day, no one may be able to know, because money must be portable. It must be something that you can easily carry. Money must also be scarce. One of the most important components, or one of the issues we study under economics, is what we call the aspect of scarcity. You can imagine if at all money was not scarce. Could we be in class today? Could you be learning today? That is why we say money must be scarce. It must be limited in supply. This forms the aspect of us continually going on with production. Durability. It has to pass through many different hands during its working life. Money must be durable. I'm yet to find out, or yes, you can also find out, at the back of that note that you have, is there an expiry date? That you can say, money is going to expire on this specific date. Not really. That is why we are saying it must be durable. That is why you find so much money going around and such, and it must exchange different hands during its working life. And a question comes on board, and we ask ourselves, from a critical perspective, how is it possible? How is it possible to bring on board the issue of durability? If you look at our currencies in the country, which is the most influential, which is the currency that has gone round and round? If you get 1,000 notes or the 50 shillings notes, which one of them is the one that has an aspect of circulating more? Which one is more durable? Some food for thought. The next one, we talk about divisibility. It is divisible into smaller units or denominations. And this is where we can demonstrate that from our Kenyan perspective, we have the 1,000 notes, which must also be divisible to the 500 shillings. It must be divisible to 200 shillings. We can go on 100 shillings. We can even demonstrate the 50 shillings, as well as even the coins. We have the 20 shillings, we have the 10 shillings, we have the 5 shillings, and also the 1 shilling. And from an economical perspective, we tend to ask ourselves a question. In circulation and in any economy performing, which one is the most important as far as transactions are concerned? Is it the 1,000 shillings or the 1 shilling? Can you do away with 1 shilling and do with 1,000, or vice versa? Some food for thought. And lastly, we talk about the aspect of homogeneity. Money must be uniform. The 1,000 shilling that you have is the same 1,000 shilling, Kenyan shilling, that somebody else has, and such. Why do we need to hold money? Why sometimes do you need money in your pocket? Why do we need money each and every time? Why do we toil each and every day? From the Keynesian perspective, and we recall from our previous lessons that Keynes was the father of macroeconomics. From the Keynesian liquidity preference theory, there are 3 main motives of why we hold money. The first one, and the most important, is the transactional motive. Day in, day out, you need to transact. You need to conduct business. You need to move from one place to another. You need to buy something. You need to pay something. You need to do all those transactions. That is why we are saying, why we hold money, the first reason is because of the transactional motive of money. The second one is also very important, more so even in this era whereby we are having or being faced with different challenges of diseases and such, the precautionary motive. We need money for purposes or emergencies that you have not catered for. You may fall sick today. You may go somewhere and maybe you don't have, you are having something that you need to currently address. That is why you need to have precautionary motive, the aspect of holding money for purposes or else for mitigating issues that may come day in, day out without your awareness. Then the third one, and this is mostly to us businessmen and such, the speculative motive. We need money to cater for advantages that may come tomorrow. I may need to save some money. I may need to hold some money from a speculative motive to take advantage of a business opportunity that may arise tomorrow and such. We go over to the banking system and we ask ourselves the previous question, or else the question that I asked, can we have money operationalizing without the banking system? And the answer is no, simply because we have even looked at some of the shortcomings of barter trade, whereby we didn't have the banking industry, the banking system, the banking sector and such. And now because we have the banking system, what does it contain? From a perspective, banking system comprises of majorly, or I'll narrow down them to three aspects. We have the commercial banks, we have the central bank, and we have the financial intermediaries. The role, or else the commercial banks, we know quite a number of commercial banks in the country, we have quite a number. Then we have the central bank, from our Kenyan perspective, which is led by the governor, and I'm sure, class, you know who is the governor of the central bank, and we also have the different financial intermediaries. Maybe we now go down to the first one, the central bank. And in this aspect, the most important, what are the functions of the central bank? The first one is, it is the government's banker. For all transactions in a country to happen, for all transactions in any environment to happen, for all businesses being conducted by the government to happen, they must store, or else they must have an account with the central bank. This is a centralized account whereby the government can do deposits, it can do withdrawals, it can write checks against these accounts, and as such, it can be able to facilitate, be it ministries, be it departments, be it parastatals, and such. The second role, or the function, is banker's bank. You can imagine a situation whereby you have no custodian, or else the banks have no custodian of their money. Then at the end of the day, we may be leading, or else we may be in a very tight situation. It is a banker's bank in that all the banks operating in a nation must have an account with the central bank, must operate an account with the central bank. This is whereby they can deposit and they can also withdraw their checks from there. And we are going to look at that maybe basically more when you'll be looking at the last function. That one is issuance of notes and coins, whereby if you look at all the notes that we have, at the extreme, it is written Banki Kuu ya Kenya, or the Central Bank of Kenya, implying that at the end of the day, it is the role and the responsibility of the central bank to make sure that they issue notes and coins. And that is why in one of the, in all the notes, you'll find the signature and the name of the governor. And for this perspective, it is Patrick Njoroge. Then there is also the issue of lender of last resort. From your own analysis class, who is the last person you go to look for or else ask for money when all avenues are closed? Maybe, is it your dad? Is it your mom? Or somebody of that sort? For this perspective, the lender of last resort mostly applies to the banks and financial institutions. Sometimes they may look for money around. They may look for chances. They may look for opportunities to get money. But all of them, they have dry areas, dry zones of money. They go to the central bank to ask for money. And that is why we are saying it is the lender of last resort. The fifth one is banking supervision. What do we mean by banking supervision? It is the responsibility of the central bank to make sure it plays the role of a prefect to the banking sector. Sometimes we complain about the banks, how they overcharge us, how they operate and such. So it is the responsibility of the central bank to make sure that they are supervising the banks and how they're operating, and mostly the commercial banks and such. You can imagine a situation whereby, even in a class perspective, whereby there is no one who is going to be in charge, there is no one who is playing the role of a lead role to make sure that there is order and stability, And this is one of the main and major responsibilities of that. Effectively and efficiently, the 5 responsibilities and functions of the central bank are important. But there is also one that is majorly important: operating monetary policy. And what do we mean by monetary policy? This is the regulation of the economy through the control of the quantity of money available and through the price of money. That is the rate of interest borrowers will have to pay. Sometimes we engage ourselves into talks whereby we ask ourselves, do we have a lot of money in the economy? Do we have less money? Do we have much money? This is an aspect of the monetary policy, whereby it is the responsibility of the government through the central bank to ensure that there is the control of quantity of money available. And this is done through what we call the interest rates borrowers are doing and borrowing. There are 2 main aspects of monetary policy that may engage the economy either positively or negatively. When there is a lot of money, the monetary policy comes on board. When there is less money, the monetary policy comes on board. What happens in each case and scenario? When you are expanding the quantity of money and lowering the rate of interest, this should stimulate spending in the economy. This is an aspect whereby we want more spending to happen in the economy. And thus, we have what you call, as we previously talked about this in our previous lessons, the expansionary or the inflationary kind of engagement. On the other hand, restricting the quantity of money and raising the rate of interests should have a restraining or deflationary effect upon the economy. So it is the responsibility of the central bank through what you call the monetary policy to guide, to also monitor, do we have a lot of money in circulation? Do we have less money in circulation? And we can ask ourselves a question: what will happen in the economy if we have a lot of money in circulation? Will we find value for our money? Some food for thought. For it to be effective, the central bank applies different instruments, and these we call instruments of monetary policy. The first one is what we call open market operations, whereby the government holds securities, and it can sell some of these or buy more on the open market, so that the stock, through the stock exchange, so that either it moves more money from the pockets of the common mwananchi, or it increases the amount of money in circulation. That is what we call the open market operations, a very important aspect. We have also what we call supplementary reserve requirements or special deposits, whereby if the central bank feels that there is too much money in circulation, it can in addition require commercial banks to maintain over and above cash or liquid assets some additional reserves in the form of special deposits. What we mean by this is sometimes if at all there is a lot of money in circulation, it is the responsibility of the central bank to trigger the special deposits component under the commercial banks, so that at the end of the day there is not much access of money to the common mwananchi or the people who are dealing with this money. And the third one is what we call the selective credit control. That is used to influence specific types of credit for particular purposes, sometimes in different sectors of the economy. And mostly in our economy we talk about different sectors of the economy and their role that they play in making sure that the economy grows or is triggered towards development. One of the sectors we talk about is the agricultural sector versus the manufacturing sector. Sometimes when we are faced with different hardships and different arenas of money in circulation, the central bank may come to the commercial banks and tell them, kindly give more credit to the manufacturing sector than the agricultural sector, so that at the end of the day it acts as a rapid response to their growth. So that is what we call selective credit control. In short, it is not a must for you to give credit to everybody. There are curtailments that come on board. And at that juncture, we challenge ourselves and ask ourselves, what are these challenges? Or else, what are some of the other mechanisms, other components, other policy instruments that need to be discussed under this? So discuss more monetary policy instruments, basically. Having talked about that, what is the objective of monetary policy? What are the main objectives? And sometimes there is always a kind of marriage between the objectives of monetary policy and also the objectives of macroeconomics policy. The objectives of monetary policy include: one, Stability of prices. Everybody wants in a country whereby the price of commodity today is 50 shillings, tomorrow 50 or 51. But we don't want an aspect whereby today it is 50 shillings, tomorrow it is 56 shillings, the other day it's 100 shillings. Then we will not be having stability of prices. So through the monetary policy, we can be able and we can be sure that we are maintaining stability of prices. The second one is stability in exchange rates. Sometimes, and we look at different types of exchange rates. We have the fluctuating ones and the fixed ones. So at the end of the day, do we have stability in exchange rates? Is our shilling trading today at 100 shillings against US dollar, tomorrow it is 110, without any kind of stability? We want a situation whereby our economy can grow to stable conditions. Another objective is full employment. And we even tend to ask ourselves a question: have we been able to achieve full employment as a country? Can everybody say he is trained for a specific job A, he is being paid for specific job A, and he is doing comfortably specific job A without the economy struggling? One of the responsibilities and objectives of monetary policy is to ensure there is what we call full employment. And the last one we can talk about there is economic growth, making sure that our economy is able to grow. And in terms of growing, that is expanding our capacity to grow, expanding our production capacity, whereby as a country, or as a developing country, Kenya being a developing country, we can be able to say that we are growing at a certain percentage effectively as a result of monetary policy. In line with that, we also look at commercial banks and their functions. And one of them is they provide a safe deposit for money and other valuables. That is why you have the confidence of walking through a bank or else into a bank, go into the banking mall, deposit your money, and at the end of the day, they will have what we call a safe deposit for your money. And sometimes, unless there are issues that have been dictated by the central bank, then it is always an issue of safe deposit. Because you don't want also to take your money to a place whereby you are not sure if tomorrow you'll get your money. They lend money to borrowers, that is in terms of loans. That is why you can walk into a bank, apply for a loan, as long as you qualify, and they are able to give you loans, be it overdrafts, be it long-term loans, or be it short-term loans. They also act as agents of the central banks in dealings involving foreign exchange. Sometimes we want to exchange the Kenyan shilling against the US dollar, the Kenyan shilling against the South African rand, the Kenyan shilling against the Indian rupee, the Kenyan shilling against the Rwandese what class? That one. So at the end of the day, how do you get to this? It is through the commercial banks. They also offer management advisory services, especially to enterprises. Sometimes you walk into the bank and you want to get some kind of assistance. You want to invest somewhere. And these are people who are experts in money relations. And we have seen the last one, and whereby now banks, because of the competition aspect, they are coming on board. They are becoming agencies of insurance, agencies of other aspects, and at the end of the day, you look at that. So having said that, and having looked at that, class, it is important for you to know all that we have discussed in a nutshell. When you're talking about money and banking, we cannot talk about, talk less about commercial banks, we cannot talk less about central banks, and we can also not talk less about monetary policy being an aspect that is important. In our next lesson, class, we will be looking at money and capital markets. We will be going deeper into that. And then lastly, we'll be looking at the ISLM model from a graphical perspective as well as from a mathematical perspective. And it is important for you to be, in a nutshell, be looking at this before our next lesson. Thank you so much, class, and I'm sure you are staying safe in this era that we are faced with different challenges. Thank you so much.
These televised lectures supplement our robust online learning going on our MKU online platform. You can view more on our televised lectures via our online platform. We are in a digital era, and Mount Kenya University knows this. The following are the steps to follow so as to complete your online application. Download the application form from the website www.mku.ac.ke. Attach copies of your academic certificates and ID. Pay the application fees via M-Pesa pay bill number 270988. Your ID is the account number. 2,000 shillings is the charge for a postgraduate. You can also deposit in the bank accounts provided on the website. Then email all the above to apply@mku.ac.ke.